Welcome to People in Profit. I'm Kate Moody. The US and Israel's war with Iran has sent shockwaves across the global economy and created the largest energy crisis in decades. Virtually all regions of the world are feeling some impact, but China, the world's second largest economy, has by many measures appeared insulated from the worst of the fallout. GDP expanded by a faster than expected 5% in the first quarter of the year. That includes the month of March, which saw violence rock the Middle East and the Strait of Hormuz effectively closed. But concerns were nevertheless on display at the Canton Trade Fair in April, as Yuka Royer explains.
It's China's largest and oldest trade show spanning 7 decades, and this edition of the Canton Fair is the biggest yet, with exhibition space, number of booths and participating companies all reaching record highs. Yet war is casting a huge shadow. One trader says it was a nightmare even to get here.
We had to change our flight, and it was very bad because the ticket gets three times higher than the other ticket. And we spent 48 hours to get here.
It's traditionally been a venue for foreign buyers to meet face-to-face with Chinese manufacturers and strike deals directly. The conflict has upended business.
Our entire Middle East sales basically halted. Marketing promotions and personnel exchanges are all affected by flight cancellations. Our logistics are also impacted.
They just don't want to order right now because they don't want to ship and the orders stick in the way, So it's quite difficult and our business is getting low now.
Our product prices have risen because raw material costs have gone up. Labor costs have also seen a slight uptick, and as a result, we've had to raise our overall pricing.
While China has so far weathered the Gulf energy shock better than some of its neighbours thanks to its large oil reserves and advanced renewable grid, its economy has taken a hit. Export in March grew just 2.5% from a year ago, down from about 22% over the first 2 months of the year. The International Monetary Fund has now downgraded the country's GDP growth forecast to just 4.4%.
We're joined now by Leah Fahey, senior economist of the China team at Capital Economics. Thanks for being on the show today. First of all, were you surprised by the resilience of China's economy in that first quarter GDP bounce?
I think in some ways, yes, but really, if you looked at the export data over January and February, it was so incredibly strong that there was kind of very little world in which China wasn't going to have a pretty strong performance in the first quarter. And I think when you dig into the data, that's the key thing that stands out is that, China's economy is growing at a lot faster pace than a lot of people expected, but it's becoming increasingly dependent on exports for growth. So we saw kind of an increasing share of China's growth in Q1 being driven by external demand rather than the domestic market.
When we look at the current conflict, one of the things that makes China less exposed than some of its neighbors is its diverse energy mix. Coal is the biggest power source. Much of that is produced domestically. China has been the biggest buyer of crude oil from Iran, and we know that supplies of both oil and natural gas imports from the region have now been interrupted. It does, though, have significant oil reserves that are providing something of a buffer. Tell us how you see China's positioning in this unprecedented global energy shock.
Yeah, I mean, obviously, even for China, a big spike in energy prices and oil prices is a bad thing, and it's going to have some kind of negative impacts domestically. But I think we really need to frame this in terms of the global picture. So when you compare China's economy to those in the rest of the world, as you say, China's economy is much less dependent on oil and natural gas. Around 60% of its energy still comes from coal, and it's got kind of a big and pretty quickly growing renewable energy infrastructure as well. And so then when you place kind of China in the context of other countries, it's seeing a much smaller shock to energy prices than everywhere else in the world. And particularly when you think about Chinese manufacturers, the share of kind of electricity generation in China that comes from oil and gas is really quite small in comparison to the rest of the world. So what that means is that manufacturers in China are actually facing smaller price increases than those in the rest of the world. And so if anything, as much as it does kind of boost input prices for Chinese manufacturers too, it means that Chinese goods become even more competitive on the global scale.
When it comes to renewables, China is in a stronger position than some other economies, not just because it's been rolling out solar, wind and hydropower across the country, but because it also dominates the production of materials and components that are needed to develop that technology for other economies.
Yeah, exactly. I mean, we've been looking at the breakdown of China's exports of what they call kind of the new three green technologies in March, and particularly when you look at lithium-ion batteries. So those are kind of the things that are used in electric vehicles, among other technologies, as well as solar panels. Those have absolutely surged in March. You haven't seen as big of a pickup in electric vehicle exports, but I think that more reflects kind of the logistic difficulties in transporting vehicles. So you might see a bit more of a delay between orders being placed and them actually being shipped. But I think the big picture is that both within China and globally, we're going to see a surge in global demand for these new green technologies. And as you say, China kind of dominates the production of these goods. And so it could be a pretty significant upside to China's exports. I mean, we've estimated that, I think, just with kind of a pickup in global demand for electric vehicles alone, autos could add about 1 percentage point to China's export growth this year.
So quite a lot of opportunity for Beijing there. Russia is another player in all this. It's looking to provide more energy to the global market, more oil and gas to trading partners that include China. Is this an opportunity for those two countries to perhaps further strengthen their economic ties?
Yeah, in some ways, and I think you have seen kind of China and Russia moving closer along those channels. But I think the important thing to think about in the context of Russia and China's relationship is that it really is one that is kind of on China's terms. So, you have a strong economic relationship when it comes to trade. China importing a lot of energy from Russia, exporting a lot of manufactured goods to Russia. But then beyond that, when you think about kind of investment flows more broadly, you're not seeing as much of a pickup there. I guess from Russia's perspective, it has lost a couple key allies in Syria and Iran of late, so it might be looking to kind of strengthen ties with China geopolitically there. But yeah, I think it's a relationship that really seems to be increasingly on China's terms these days.
Where do you see China's biggest weaknesses, the biggest chance of exposure in this current conflict?
Yeah, that's a good question. I think obviously one of the key points is that China imports a lot of its oil directly from Iran. I mean, commodities, oil particularly, they're kind of globally traded goods, so it's not like China can't get that elsewhere. But I think there is kind of a geopolitical risk that China continues to try and kind of get oil imports from Iran, where the US is trying to block those from going through, and that kind of leads to a bigger geopolitical fallout between the US and China. So maybe less the impact of higher oil prices per se, but more the kind of broader geopolitical fallout.
And we've been hearing reports that China's playing perhaps a more behind-the-scenes role, a sort of quiet peacemaker or deal maker there. Do you think that this gives China an opportunity to broker new alliances or perhaps boost its own position on the global stage?
Yeah, certainly. And I think a lot of the kind of US's unconventional, so to speak, foreign policy of late and tariff policy as well has helped China on that front. So you're seeing increasingly Xi Jinping and kind of the Chinese leadership more broadly trying to place China in this elevated global role, both as kind of a global arbiter, negotiator, and also in some kind of instances, the defender of global free trade, which is quite it's not the position you would have expected China to be putting itself in a few years ago, let's put it that way.
You alluded there to that rather uncertain trade policy, at least, that we've had from Washington. The US President Donald Trump is due to visit Beijing in May. We've seen a lot of back and forth about tariffs, about blacklisting Chinese companies, about semiconductors, other advanced technology. What's at stake for the two biggest economies in the world here? Are you expecting any sort of change in position or possible breakthrough in the coming weeks?
To be honest, I think a massive breakthrough is pretty unlikely. Ultimately, China has a massive kind of domestic overcapacity issue. It has loads of goods to export. The US has a kind of pretty strong domestic demand for those goods. And so the outcome is always going to be China exporting more to the US than the US is willing to import. You've got tariffs coming into place to kind of try and stop those flows. But I'm not sure there's kind of any obvious compromise that each side can come to that's going to kind of please either party. Obviously, you've got kind of certain technology restrictions that the US has on China, on semiconductors, certain kind of AI technology and so on. And you might see kind of Trump trying to give a little there to get concessions from China when it comes to trade. But ultimately, I think they have quite distinctly competing priorities, the US and China. China wants to continue exporting to the world, increase its domestic self-sufficiency, and develop its own domestic technology. And the US wants to stop China from developing these key technologies and also stop China's massive global trade surplus from widening further.
So what will you be really keeping an eye on during that visit? What are you going to be trying to look out for?
Yeah, I think the key thing to look out for is kind of, first of all, any numbers. It's quite easy to agree to import more from the US, from China's end. But if we're not seeing kind of hard figures, there's not going to be much follow through on that front. Also kind of how feasible any numbers that are agreed upon are. I think probably the most interesting thing will be any sort of concessions on tech policy. The US's export controls on kind of key semiconductor chips as well as manufacturing equipment have been kind of a sticking point for China and its domestic AI development. And so if you saw kind of any give there, that would be really positive for China.
All right, Leah Fay from Capital Economics, thank you so much for joining us on the program today. Well, that's all for now. Don't forget you can catch our previous shows on the France 24 website or as a podcast wherever you usually listen. Until next time, thanks for watching.